Going live, and with that, we are live. Good morning, afternoon, evening. We've seen quite some time zones, geographies, regions represented today. So, Anna and myself are very glad to have you with us today, as shown on the screen. Today, here to talk about CSRD reporting in 2026 and beyond. With a deep dive around insights and guidance from my partner Anna at EFRAG, and ourselves at KEY ESG will do a bit more of an intro shortly. But already today, I wanted to, for those folks that made it into the webinar, to say welcome. Look at the title. If this is not what you had expected, this is also a chance to move elsewhere. But otherwise, really glad to have you with us today. And let's look at what we have in plan for you in terms of the agenda. So we'll have 45 minutes of a session together, and we'll start with telling a bit more about who. I'll start with myself. Who am I? What is KEY ESG? And then I'll introduce my co-host for today, Anna. So we'll do a bit of an intro there. Then what I'm sure many of you are very excited and keen for is a detailed update from the EFRAG, and particular around the revisions that some of you that have been following it very closely may already have been aware and have been familiar, but would love to just get a recap and one overview of what are the famous post omnibus revisions that we can expect that are not yet adopted but are in the works, as well as a as best as possible overview on timelines, which from the pre-session Q&A we know is very top of mind for many of you, which is very understandable. So that will be a dedicated session where my co-host will walk us through EFRAG materials and guidance. I have seen already a few questions for the webinar. There is an opportunity to today use and leverage the in-webinar question bot or chat box. So do feel free to chime in with any thoughts you have. We will try, as you can see here, we have at the end the Q&A, because we will then try to get through most of them, and if not, to follow up offline. Reversely, for myself, for the EFRAG, it's also always very helpful to see what are the questions that are on folks' minds, because it helps us on the software side to make sure that we provide solutions that really are solving the business user needs. And I'm sure on the EFRAG side gives a bit of clarity around, hey, what are the areas where more guidance would be helpful. So after the big EFRAG update, we'll segue into what are the opportunities that digital solutions such as KEY ESG can have to streamline and make repeatable through AI or CSD reporting. So we'll make it a bit more concrete, like what does it actually mean to, in a large multi-entity, multi-country context, report on the ESRS disclosures and a double materiality. So we'll spend a bit of time making that tangible for yourselves. And with that, we hope to give you a very fully packed agenda. As mentioned here, we are planning to share the recording afterwards with any folks that have registered, to give you the opportunity to share this internally with colleagues, or just revisit and rejoice in the all the learnings had. So again, with that agenda, wanted to also, having had a look at the folks that are dialing in from our customer base and our wider orbit, it's great to see represented what I already mentioned, a lot of different countries. What we've also seen on the sign-up list is a lot of different industries. So we have all verticals close to represented, Anna, so that's helpful also for context that all the verticals that one could almost imagine in an industry are with us today. So with that, let me tell you a bit more about the speakers today. And maybe I'll start with myself, Head of Product and COO at KEY ESG. My name is Anna Marie. I should probably have led with that, but for now, otherwise, nice to meet you on screen. And if you have been with us for a while, you know that we've been talking about CSRD since the last 3 years. So we've gone through a journey together, and it's really great pleasure for me to have Anna with me today, who has also been joining us on stage on frequent times. I will let her introduce herself when she kicks off her session to make it a bit more streamlined. So maybe first on my side, next page around the what is it that we do? Why are we bringing this forum together? First of all, we think it's very important as an ecosystem of reporters, filers, auditors, verifiers, regulators, technical advisory committees, and digital solution providers like ourselves to work together. CSRD and many other frameworks that I'm sure folks are dialing in with, are dialing in today, are also dealing with, such as the IFRS S1, S2, such as carbon accounting, California, etc. I think all of those, as you know, are emerging, are new, are up for change. So we think it's very important to be part of those conversations and bringing stakeholders together. Our role specifically in these challenges is that we provide AI-led sustainability software to help organizations comply with the different frameworks. Today we'll focus on CSRD, but we do have experience, and we do see a lot of overlap between the different frameworks, which I'm sure is also one of the questions that will come up later. So for today, a deep dive on CSRD, but the same principles of what is it that the business actually needs to get that done, to operationalize it through software at a company level, is very similar across different frameworks. And we'd love to tell you more about how we do that. Maybe not today on this webinar, but anytime we're keen to share more. So with that, I'll hand it over to my co-host to introduce herself briefly, explain a bit more about EFRAG, and then go into the 2026 insights. So thank you, Anna, for being here today.
Thank you so much, Anne-Marie, for having me here, and thank you for this great webinar. Short introduction on my side. My name is Anna Dotey. I focus at EFRAG at the climate topics mainly. And just to give you a bit of background, I joined first towards the end of the organization, towards the end of 2022. So I had a bit of a flavor of the standard setting into some called first set of standards. And now I will have a pleasure to take you through the revised ESRS. So let's start with going to the next slide. I am obliged to start with a quick disclaimer. So I need to mention the views I'm sharing obviously are views of my own, because EFRAG, with this particular governance process, has the position approved by the board, and they are published on our websites. That being said, we can start with giving you some background about the revision. So let's move to the next slide. So I'd like to start by giving you a bit of context on the process of the revision itself. As you might recall, following the EFRAG mandate that we've got from the European Commission at the end of March 2025, we had to move very fast to simplify the standards. So what we've done in April, we launched first the call for input, and we've managed to get quite an impressive feedback from different stakeholders. And to give you a few numbers to illustrate what I mean by impressive feedback, we've got back then an input of over 800 different organizations. We've also, on top of that, carried over 40 different one-to-one events. We've analyzed over 600 sustainability reports and reviewed hundreds of questions through the Q&A platform. So all that work was incredibly helpful for us in order to identify what are the provisions that are most in the need of a simplification. And based on that, our board, our SRB, as we refer to it, has set strategic directions for simplification. You might see them as in the papers we publish, called as simplification levers. And then, thanks to the work with the board and EFRAG TEG, so the technical expert group, we've developed the exposure drafts of the revised ESRS that were put into a public consultation end of July 25 for 60 days of a public feedback. That again has allowed us to get a lot of useful input. We've got over 700 responses. We also carried outreach events. We also carried the field tests. So altogether, very, very helpful knowledge that really allowed us to further improve the standards and then to hand them over to the European Commission in December last year. So very, very recently. Now, looking ahead, what happens next? The technical advice is in the hands of a commission. There is an expectation that the revised standards will be published as delegated acts around the mid of this year, so that they can become officially applicable from the reporting year starting on 2027. Now, moving forward, I will now start to take you, moving to the next slide, through the simplifications of ESRS. And before I dive into details, because we obviously have a package related to each single standard, I want to give you a high idea of what to expect overall. As you might probably realize, we tried to keep the core organization and principles. So we still have two cross-cutting standards, and we still have the topical standards, but we really worked a lot to introduce an important simplifications in each of them. On one hand, in principle, we really wanted to put focus on what is the useful information. So you will see there is a much stronger relevance filter. We tried to avoid what some refer to as kind of a box ticking exercise. We simplified the materiality assessment. We provided a clearer guidance with less documentation, with better alignment with also expectations of the auditors. We try to reduce the pressure on the value chain data. And also we introduced major reliefs. I will mention them in detail later, but you will see a lot of proportionality mechanism, phase-in requirements, which are helping companies with the most difficult disclosures. Overall, we try to make the narrative reporting much more principle-based. We try to grant the flexibility in how the policies, actions, targets are addressed. Overall, I would say the standards are much shorter. The benchmark of this could be reflected, for example, in the number of data points. So we have 61 fewer mandatory data points, and we have stripped out all of the voluntary data points. And last but not least, we also work to strengthen the interoperability with standards such as ISSB. Moving forward to the next slide, I will start with the cross-cutting issues. So I want to start by speaking about the DMA, so the double materiality assessment. Aside from what I already mentioned, so to emphasizing the materiality assessment as the main filter, we also narrowed the focus to a very defined primary users. We emphasized the concept of the fair presentation in standards. The fair presentation was before in the standard, but it was more implicit. Now we really made it explicit to help companies to focus on what really matters and to avoid what some were calling a pure compliance exercise that would result in over-reporting. We have rewrote the chapter on materiality assessment. We've then also converted the appendix to the standard that were listing different sustainability topics. You might recall we called it AR16. We made it purely illustrative and we really reduced its size. And also we made sure to grant more flexibility to decide at which level companies should disaggregate the information. Moving forward, I mentioned burden reliefs and different proportionality mechanism. And here, a few things to note and to keep in mind. We introduced the undue cost or effort mechanism, and that is, we expect something that can help if collecting the data is too costly or too difficult for the companies. We introduced the reliefs on the acquisitions and disposals. This basically relates to new subsidiaries and businesses. The relief for metrics due to the lack of data. So, for example, companies can report partial coverage for metrics. There is also relief for metrics when activities are not drivers of a material IROS, so-called impacts, risk, opportunities. We had removed the preference for direct data to reduce the pressure on collecting necessarily direct data. Companies can also use estimates. We introduced relief related to the joint operations and then different transitional provisions. You can read them at length in the ESRS 1. That notably also refer to the anticipated financial effects, where we've heard that there is a lot of concerns about data quality projections, sensitivity concerns. And then finally, we also introduced the provision on the confidentiality, which is referring also to the local regulations, but the baseline of it is that the companies can omit the commercially sensitive information if the European laws are recognizing them as such. Moving ahead to the ESRS 2, so the so-called general disclosures. And maybe just to mention, I might have mentioned it before, for the sake of time, this presentation can be available for you. So I might sometimes, in order to move a little quicker, I might just highlight you the key elements of changes. And especially with the ESRS2, we've made a lot of streamlining. So a few let's say, high-level items to point you towards. The provisions on the basis for sustainability statement, the provisions on governance were importantly reduced. We've also done a lot of simplifications in the strategy business model provisions. For example, for those that recall the disclosure related to the activities in the particular sectors, the SBM1 disclosure is now more principle-based. With regards to the disclosure related to the SBM3, which, among other things, speaks to the anticipated financial effects, we've also introduced additional reliefs, phase-ins there. We've simplified the disclosure, and we also focused the resilience analysis that is therein on the qualitative aspects. On the side of disclosures related to the IROS, so the impacts, risk, opportunities, we also try to be very concise, to focus on the minimum description of what is the outcome of the analysis that the company is doing. And then finally, with regards to the general disclosure requirements, those are the disclosures that we previously referred to as MDR. We've made a lot of simplifications, and there's been a substantial work there to avoid the overlap with the topical standards. So when we have a reference to those standards in topical, to these disclosures in topical standards, we really made sure that they are as lean as possible and there is no repetitions in between. Moving forward, now we will go to the slide that relates to the climate change. Which is obviously a big part of all the standards. Few highlights. Again, many different changes, but it might be important to put to your attention first the changes on the transition plan. You will see that there is much more focused, reduced narrative approach to the disclosure that overall is much closer aligned with the IFRS, and it also reduces some data points. Another important highlight for the impacts, risk, opportunities, and resilience disclosures, we also aimed to streamline it and to really highlight the relation between scenario analysis and analysis of climate resilience. We also emphasized, and that is something that we've heard a lot from the stakeholders, that the analysis of scenario is a voluntary activity. So that's important. Another highlight related to targets, and if we have here financial institutions with us, that's probably for you. We have introduced an exemption from translating intensity targets to absolute targets for the Scope 3 Category 15. That was something that was extensively discussed and that was very important to the stakeholders that provided us feedback. We've also offered a few other flexibilities. So, for example, base year, we've also had extensive discussions about net zero provisions, and we've included them in the standard. On the metric side, both for energy and for greenhouse gas emissions, we have removed the intensity metrics. We've clarified the approach to the boundary for greenhouse gas emissions. We've simplified the provisions on biogenic emissions, and also the disclosure related to the Scope 1 from emission trading schemes was also narrowed down only to the EU ETS. And then, of course, last but not least, we simplified the provisions on the anticipated financial effect. Several data points deleted, also more flexibility have been added there. Now, moving forward, we will stop quickly on the ESRS 2 and ESRS 3, so the pollution and the water. For pollution, we wanted to focus on material pollutants. So we moved the EPRTR provisions to the application requirements. So we don't want to require a comprehensive list of pollutants, but really follow the materiality principle. So the standard speaks only to the ones that are relevant to the companies. We've introduced also the qualitative disclosures on the secondary microplastics. We've made a lot of refinements related to substances of concern and of very high concern. So the reporting of those is limited to specific business. There is also a phase-in period with regards to those to this reporting. And for water, we have, first of all, we have eliminated the notion of marine resources. As you might remember, it was also in the name of the standard. We clarified the scope of disclosures, simplified the provisions on the water stress areas. We've clarified all the concepts through the methodological guidance, and overall, you will see the disclosure focuses now on water withdrawals and discharges. And here again, like in greenhouse gases, we removed also the water intensity metrics. Then finally, to end up the environmental part with the E4 and E5, so biodiversity, ecosystems, and then circular economy, a few items of note. For biodiversity and ecosystems, we made sure that the transition plan disclosure is a subject to conditional provisions. So if it's made public, the disclosures also on the policies, actions, targets were simplified, focused on very core elements. We've also aggregated the location-specific disclosures in one specific section of the standard for more clarity for the preparers. And for the resource use and circular economy, the standard speaks now only to the key materials, which is a term that is defined in the glossary. The secondary resources disclosure was also streamlined. And then finally, we've also, by the means of exception, but we've added a data point related to the percentage of waste with the unknown destination. Because basically what we've heard from preparers is that sometimes it's very difficult to know where your waste ends up. And that additional reconciliation point can actually be very, very helpful to not to make too much not to impose too much burden with disclosure. Moving forward, we are going to stop now for the to go through the social standards. And looking at the slide, I'm really glad we shared the presentation with you. Just a few highlights. Standards were importantly reduced. We've also here leveraged on the cross-cutting standards. So we try to eliminate any redundancies. From technical side, some items of note would be the revision of thresholds for disclosure, which speaks to the characteristics of employees and to the collective bargaining. We've also clarified materiality for the non-employees disclosures. We've updated methodology on the adequate wages based on the ILO principles. We've removed requirements related to fatalities due to the ill health. And also, we have made adjustments on the days lost calculation. It excludes fatalities right now. We've also retained unadjusted gender pay gap, but also added some explanations towards that. And we've clarified the materiality of human rights incidents, adding some definitions to help the preparers there. And lastly, the governance standards, so the business conduct, that is the last slide I prepared for you. We've removed, again, the most granular data points. We try to focus on supplier relationships, corruption, bribery, and whistleblowing as the main topics. We've added more guidance to the reporting and also deleted provisions such as, for example, voluntary data points for confirmed incidents of corruption. Finally, we also work to clarify the scope of disclosure on the convictions, fines, sanctions. We reduced the size of disclosures on the political influence and lobbying, and then we have removed the reporting of the average time to pay. And that being said, I think I went through all of the standards at a very high level, obviously, but thank you so much. And sorry for a very dense presentation. I'd be happy to hand over to you, Anne-Marie, and then probably towards the end we take the questions. Thank you so much.
Great. And Anna, we should say thank you for being able to power through those while staying both insightful, succinct, and comprehensive. So well done. And I hope you're still sitting straight after that. No, and to reiterate, we will be sharing these materials with folks after, as I'm sure also on this page, a lot more guidance from the EFRAG is available to folks online. Um, okay, so with that framework, right, and walking through the simplification, which hopefully does sound like a positive word for folks on the phone, particularly those that may have been already part of Wave One. So I wanted to go through high level. How do you actually think about operationalizing the standards, whether you are dialing in as a company that has already done Wave One, or whether you're a company that would be in scope potentially in the post omnibus world. So I wanted to use the opportunity to talk through ways in which a software can help you take tangible steps on the new CSRD. We as a provider have already live the pre-simplification, so the pre-omnibus approach for CSRD, which includes. So I wanted to go high level. I will not go through every detail, but I think to really make concrete, what does it actually mean to support your internal, to support your external efforts, because we very see ourselves as very complementary to advisors that you and your organizations may have brought in. So what would actually a software do and enable you there? So first of all, it would help you to digitize double materiality. There's year on year a recurring need to report on that. So really bringing those insights from internally as well as from external support into one repository, and then connecting it to your data collection powered by AI. We'll show you a video on after this slide to make it a bit more come to life. But the simplification is bringing us good news. The number of data points is going down. But there still remains quite a sizable amount where there's a lot of opportunity with new technologies like AI to make that more straightforward and foolproof. We will then also show you how, let's say you've gone through that exercise, you've thought about within your company which of your colleagues, which of your business units, which of your entities are needing to contribute, because if you report on a consolidated level, you will need folks across the organization to drive your input, to then also help you once all of that has been collated through the software to review and analyze the quality in platform, to make sure that you agree with what finally is going to go on that public display. And now in all of this, what's essential is the ability to build digital compliance and quality checks. So it's really about the controls. Do we have the right controls in place during data submission, data verification, with your internal control and audit colleagues, but also with your external auditors? So a few highlight elements. We won't go into the full depth here, but wanted to make it a bit more tangible for folks that are dialing in that may have gone through Wave 1 manually to understand what could it look like digitally, but also for folks that are just about to embark on this to get a sense for how a key ESG could help you on the journey. What we'll do, and I'm just pulling them up on my side here. Maybe what we'll do is we'll start with the question from a sequence event. Let's start with the double materiality. One of the things that were brought up is, what if me and my organization, we have already worked on the pre omnibus DMA? Is it wise to revisit the new DMA and redo the exercise, or are they so equal in spirit that we should be able to do the quote unquote new DMA with quite similar outcomes that we had in the prior DMA? So any guidance that you could share on that, on how folks can think about that transition?
Thank you so much, and thank you for a very good question. I'll try to be brief because I think we have lots of good questions also in the chat. But basically, I think what's important to say here, the double materiality principle itself hasn't been changed. So the companies are still in a situation where they would be assessing both the impact materiality and the financial materiality. What we've been doing in the revision process is to try to streamline how the assessment of the double materiality is carried out and evidenced, but the bottom line is that the same principles are still applicable in terms of the work. We really wanted to move out from the as some call it, the checklist-driven exercise. So we introduced the things that I've mentioned at the beginning. So the fair presentation, the emphasis of materiality of information, the reasonable, supportable information. Um, Perhaps important to mention also, we've included explicit provision that the DMA does not need to be fully redone every year as well. So that's also speaks perhaps a little bit to the question. But in the first place, I wanted to highlight that these underlying principles were very much preserved. Now, speaking to different ways of transitioning from the old to the new standards, and for example, how companies should do this in 2025 or 2026 reporting year. I think it's really tricky to give a kind of a top-down answer that would fit everybody, because it really depends on where the company is vis-a-vis the scope of CSRD. It will really drive that decision. So depending on in which category of companies you are, you might need to take into account what is the status of the standards, what's the status of the transposition. So I would also point out to that, as that is probably quite an important element of the whole exercise. But thank you for the question.
Thank you, Anna. Then moving from the double materiality into the actual, so the standards itself. So the what are the metrics, data points, qualitative, quantitative, that we are reporting on. The first question that came is, what is likely what is maybe at the latest when we can expect them to be confirmed? And maybe we don't know when they will be, but what will be the very final time that folks could count on that?
So I'll try to take actually two. I really like the question about the expected changes, even though I have to recognize this is a little bit of a future forward-looking, a little bit maybe a crystal ball question. But I'll start with the timing. So the best expectation we have is that the Commission will adopt the standards as a delegated act around July. And to give you a bit more context, and that can probably be a proxy of any expectations of what's going on with the standards. So what's happening now is that the Commission is right now consulting the technical advice that we gave them with the member states and also with the 8 supervisory bodies. And once that is going to be finished, there will be also a short period of public feedback organized by the Commission on this time around, which is according to the Better Regulation Toolkit, and that is something that typically takes around 4 weeks. And I would venture to say, hopefully, that is going to be already very, very close to the final version. But ultimately, the objective is to adopt the delegated acts and to publish them in the official journal in June, so that the reporting starts in 2027.
And what you're saying is that there is a step prior where actually the public, so all of us on the phone, we could see what is likely to be the final list. So that is something to keep our eyes on. Okay.
Yes, exactly. This is the public feedback that I referred to, where the Commission will publish the version that comes out of the inter-service consultations and ask also for additional views.
Okay. Helpful and hopeful. Great, thank you for that. And maybe related to that, right? So there are some folks that are dialing in that are dialing in today, so are really committed and are seeing a lot of value on the exercise, but are struggling to get leadership buy-in in a world where they may indeed only have to report as of 27 data and 28. Is there any strategies that that you've seen, heard, and I can allude to it from a business perspective, but any thoughts from the EFRAG side around that, around how to get the buy-in there?
Very, very, very good question. I would love to hear your view as well, Anne-Marie, because it really goes to the strategy aspects of business. Um, I would say, personally, if I may, I think that I would suggest maybe the conversation should really focus on the value of the reporting rather than the for example, threshold exercise and whether we are in a particular scope, especially once we are in a situation where companies have already invested in all the systems, infrastructure to do the sustainability reporting. And and I say it because I do believe that we have major sustainability challenges ahead. There is a more and more connection between those challenges and the company performance. And I do believe that when the reporting is done properly and in principle based, it really can help to better manage the sustainability impacts, risk, opportunities. And the standards, as they are, they kind of provide, some say common language, but I would say framework to do it in a very organized way. So once you do it this way, it sort of stops being about compliance. It starts being about the strategy, the management, rather than any obligations. So my few cents here would be to really focus on this added value of ESRS and standards as a framework.
Yes, and I would say that from the what do we see in practice, I think the resounding feedback is that the exercise, particularly around the double materiality, which is that entry point into knowing what to disclose, has been yeah, really to your point, has been really seen as, hey, this is very a helpful framework for us as an organization to really focus our efforts to understand where the materiality sits, and has been found, particularly because the exercise requires that senior and external yeah, buy-in. So you have had opportunities to engage with your buyers, your suppliers on these topics. So I haven't heard anyone yet that hasn't found that process leading to helpful insights. So I would say that the regardless of whether folks are in and out of scope, that has been the feedback. I also see a lot of folks doing it voluntarily, and with that, are increasingly, yeah, in every vertical you're active in, you will also have peers that are doing and reporting voluntarily without being in scope. So that could be another statistics to look at. So have a think about what is your competitive landscape, and who is the top 5 or 10 peers that your senior team would be comparing themselves with, and yeah, reviewing. We have as Key ESG, we have online a library of all the reports that we are keeping track of. So have a look if they're in there, because we found that there's a lot of folks that are not officially that were not officially in scope in wave one, but are voluntarily disclosing fully or partially on the ESRS. So I think that's another great, yeah, another great point. Now, a more nuanced question on this, one of the things around that scoping, trash and thresholding. One question that came in is about whether or not we should focus on FTE or headcount. So before clarifying that, one of the things that we would warrant folks is indeed, if your organization is one of yeah, active inorganic growth, meaning you have a buy and build or yeah, growth strategy through M&A, you may this year still be quite far away from the threshold, regardless on whether it's FTE or headcount. But these things are, yeah, you want to get ready for when you do cross the headcount, and ideally having had a dry run before that. So don't take them to absolute, but really, yeah, give yourself a bit of a cushion. But Anna, anything you can say on the nuance between those two terms?
Yeah, so it's also a very good question. I mean, the accounting directive, which is planned to be amended, speaks to quote unquote the average number of employees during the financial year. So I do believe, but of course I'm specialist in climate, but I do believe that that is closer to the headcount rather than the FTE notion. And in that sense, we do have indeed the thresholds introduced, which refer to over 1,000 employees and the 450 million turnover that you probably know.
Yeah. Okay, then maybe, and I know we're getting close to the end time, but I think your area of expertise and probably also interest, and some of the outstanding questions are around GHG emissions. So could you, for those folks that are keen, and if you're willing to spend a few more minutes to speak us through the GHG emissions, and I'm opening up the questions. I think you already had a chance to look at them as well. I think it's about scoping in terms of JVs, etc. Maybe
Yes.
that one, maybe we take that one first.
Yes, I will definitely take that. Thank you, Christine, for a very nice detailed question. So the question is how the reporting boundary for Scope 3 is defined. Should emissions from associated joint ventures and consolidated subsidiaries joint arrangement be without operational control be still included? So I would point out to the two items. First of all, we do have a revised approach to the boundary of the greenhouse gas emissions. So the boundary is really focused on the financial control and the financial consolidation. So this is one part of the answer. But probably the second part of the answer that is maybe a little bit going more to the direction of the question that you're asking, Christine. You were inquiring about there was the application requirement in the previous standard that said that the company shall report the scope 1 to 3 of emissions from those arrangements that you mentioned when you don't have an operational control. So the short answer to your question is that this requirement has been, in principle, deleted. The standard is really relying on the high-level approach. So the detailed methodology of reporting rests within the greenhouse gas protocol, which is referred to as shall consider. So the bottom line is that basically it is that the ESRS is neither requiring or preventing you to report the emissions from those arrangements. And I would add, maybe from my perspective, I could imagine well a situation where a company has, let's say, for example, unconsolidated subsidiary where they do not have operational control, but that subsidiary is also your very important supplier and it generates significant emissions. So that can be a scenario where those emissions are indeed considered as significant scope 3 as required by the revised standard. But there can be also the opposite situations to that. So ultimately, what we're doing is leaving the assessment to the preparer himself, for better and or worse, so to say. But thank you for a really good question.
And then I think the other question you mentioned in that, indeed, in terms of the simplification, intensity is now no longer required. Any more details you could share on the further finance emissions?
Yeah, I think this, thank you for picking that up. This is another question from Kirsten. I think it speaks to how the financial company should calculate attributed emissions. This is indeed something we've heard quite a lot that requires more detailed methodological guidance. However, our hands were, I would venture to say, a little bit tied because the principle we followed in revision is to be less granular in the requirements. So we try to really to take a step back and say to prepare to follow, as you mentioned actually in the chat, the greenhouse gas protocol, which is a shall consider, and the PCAF, which is, if I don't make a mistake, I may consider wording. We didn't go into the methodology of how to do it in detail, because on one hand, that would probably not be in line with the mandate and objective of simplification. And because also on the other hand, we recognize that it is a very sectoral issue and we are working on revising the sector agnostic, so to say, standards. So we haven't specified that. And this methodology, I mean, if you would consider that this is, for example, something that requires further detailing, it would be really helpful for us at EFRAG also to learn and to hear that and to take note of it.
Great, thank you. Thank you for staying a bit over to address those questions. So maybe wrapping up to the final page, what are some further resources that you could lever? So what we have is we have a number of on our, if you follow the link there, a number of resources to share wider internally, because we know that we see a lot of folks dialing in that are probably the spearheader of CSRD, but we know it's a team effort. So bringing on board your colleagues, getting that buy-in, you're not the first trying to get that. So we have provided a number of resources there for you. Second, we love virtual events, very carbon efficient and friendly, but also we do love bringing people together in person. So our next summit and next in-person get together will be in March for folks that are interested or more about that. And then finally, obviously, for anyone that would like more in-depth understanding of how one could navigate their multi-entity, multi-country organization through today discuss CSRD, but also many of the other frameworks that are likely on your mind, such as in-depth carbon accounting, IFRS S1, S2, California, etc. We'd love to tell you more. So with that and with those final resources, I want to say a very big thank you, Anna, for keeping us calm, walking us through all those revisions with a calm and composed tone. It gives us, in a time of where there is still a bit of uncertainty, because I think that's the bottom line. 26 is a year where we're a bit in between the old standards and the new standards. So thank you for at least providing us clarity and calmness around where the future is heading. We hold our fingers crossed for many more guidances that come from EFRAG. And yeah, as I think what's clear from the questions, sooner than later, but I am sure your team feels the same. So thank you for your time today, for carving that out and for taking our questions. And thank you all for joining. And appreciate the attention, and hope you all have a great week, great year, onto many more webinars and insights.
Thank you so much, Anne-Marie, and thank you for organization of this great webinar, and thank you to the audience for very pertinent and very good questions. Really appreciate it. It's a pleasure. It was a pleasure to be here.
Yeah, I agree. The questions were we had a well-read audience with us today.
Indeed.
Okay, thank you everyone, and good rest of day. Cheers.
Thank you.